Hey VV Nation, all of YouTube, what's going on? It's Patrick with VectorVest back with you once again to start your week off right. So this week we have some major economic news coming from the Fed, and that's what our main focus of today is going to be. So if you're ready to find out more, some expectations, what you should be doing to prepare yourself, make sure as always smash that like button, subscribe if you're not already subscribed, and without further ado, let's jump right into it here today. Alright, welcome back VV Nation. So as always today, with economic news, the best place to start off is investing.com. So I've talked about this website quite a lot. It's a free, great source to find all the upcoming economic news that you need to be aware of throughout the week. So I have it already pulled up. Let's go ahead and take a look at what we have planned for the week. So Monday, not a whole lot going on, but Tuesday is where we start to get into some of the juicier details that we need to keep an eye on. And that's because we have the core CPI and also the regular CPI for the month over month and year over year coming out Tuesday morning, at 8:30 a.m. So that's going to be the initial shock factor that hits the markets. If we beat the current CPI estimates or forecasts of 7.3%, meaning less than that, then we could see the markets start to rally here a little bit. But that may be short-lived. The reason why is because on Wednesday, we have the Fed coming out with their interest rate decision and their statement at 2 o'clock Eastern. Also, as a side note, if you want to see what the Fed's decision is and you want to see some analysis and some opinions on what they're doing, make sure to tune in at 2 o'clock Eastern on the VectorVest YouTube channel, as Glenn and I have our afternoon market action, where we'll be hosting this live and giving our views and opinions about what their commentary says or what their commentary is. So make sure to come hang out with us on Wednesday at 2 o'clock Eastern for our afternoon market action to get all the updates on the FOMC statement. But with that statement coming out at 2 o'clock, expect some big market moves higher and lower for that first little bit. But then realistically, 2:30 is where we start to see how the market's really reacting to what the Fed is saying there. And so that is going to be the main focus this week, is the interest rates and the CPI data that comes out. Now, as always, there's an old saying that you can't fight the Fed. Right now, they're forecasting a 0.5% increase in the interest rate, but there was talks about potentially a 3/4 point. Let me know down in the comments below what your thoughts are on which way this interest rate hike is going to be. Do you think it's going to be 0.75% or just 0.5%? Probability tells us it will be a 0.5%, but at the same time, there is still that possibility of 0.75%, especially with the CPI data coming out the day before. So make sure once again to come hang out with us at 2 o'clock Eastern for our afternoon market action to stay up to date with all this coming out. So you can't fight the Fed. As we've heard time and time again, the Fed is looking to start to switch their current policy from, instead of hiking in big chunks at a time, hiking slower but for longer. So therefore, even if it is 0.5%, markets could rally. But when you look at the longer term views, most likely that's not going to be long lived, because once again, they're still going to be hiking interest rates, and therefore that doesn't really change anything. The Fed is still not pivoting. So let's go ahead and get into VectorVest real quick. So we'll get out of here. And I wanted to first start off by taking a look at our market climate here at VectorVest. If you're not familiar with it, VectorVest covers every single week, every Friday to be exact, what the overall climate is that we use to identify which case we are in for either bear or bull markets. So if you always want to make sure you stay up to date with that, make sure to use the link down in the description below, sign up for the trial, and that way you never miss out on this information. So what we're looking at here at the very top is the ETI, or the earnings trend indicator. So this is going to be cast on a scale of 0 to 2, and above 1 indicates that earnings are continuing to rise. Below 1 would indicate that earnings are falling. Now, to be in a true bear market, earnings have to be falling, so therefore we have to see the ETI below that level of 1. Now, you may be noticing right now it's not quite below that level of 1. And that is correct. So therefore, by definition, we're not really quite in a full bear market yet, but we're definitely getting closer. Now, I wanted to start off with this because I wanted to point out here, we can see that the earnings have been trending lower ever since about the middle of summer, but still not negative yet. That indicates that while yes, earnings are slowing down, they're still rising overall. And now if we look here at the 50-day moving average of the S&P 500 earnings, you can see it also started notching lower around the middle of summer as well. So one of the things that this really tells us is that the forecast for earnings, while you've seen companies talking about how the supply chain and inflation is really going to be hurting them going forward, and the actual forecast, you haven't seen that quite baked in yet. So therefore, I think as the Fed continues to raise rates, we'll see that disconnect between how slow they are to start changing those forecasts to include the inflation and supply chain issues we've been dealing with, and the actual performance from earnings, which, as we always talk about here at VectorVest, is the main engine that drives stock prices higher over time. So if earnings aren't rising, prices of stocks will also not be rising. So keep this in mind as we move forward. Yes, we are seeing a slowdown in the pace of rate hikes, but we're not seeing rate hikes being completely ended, and we're still not seeing the Fed pivot. And this is kind of indicating that the hurt that companies are feeling right now is not truly baked into their earnings quite yet. And when you start seeing companies' earnings missing consistently, that's going to have a bigger impact on stocks dropping than what we've seen throughout all of 2022 so far. So always keep that in mind. Now, with that negative news, apologize, but it's the truth. Let's jump into the picks on how to take advantage of the plays, or how to take advantage of the Fed decision and the CPI data coming out this week. So we'll get out of here. And we've got 4 stocks to take a look at. The first one today being TLT, which is an ETF. All 4 are actually ETFs. And it's looking at the 20-year treasury bonds or treasuries. So therefore, as rate hikes increase, this could also potentially continue to go up. DRIP. I've seen a lot of people talking about oil recently, especially with the news from China that they're easing their COVID lockdowns. And from what I've seen so far, I don't think the lockdowns are going to have quite the impact everybody was hoping for. Because right now, people still, even with the lockdowns easing, aren't going out, aren't spending money, they're being cautious. So it's going to be a longer time before we see the impact of these lockdowns starting to be removed in China. So therefore, with the Fed continuing to raise rates, that's going to drive prices lower. It's going to drive stocks lower, putting us closer and closer to a recession. And then China taking a lot longer than people are going to be expecting to really ramp back up, since it's the second largest economy out there. That's going to really hurt oil prices for the foreseeable future. Then third one, DRV. We've talked about it quite a lot, but as rates continue to rise, housing prices aren't going to really be going anywhere, if anything, going down. And people really aren't going to be buying houses or refinancing their current houses with the current interest rate. So therefore, DRV, I expect to see a nice run here in the near future. And last but not least, UVXY for volatility. If this is your cup of tea, I know a lot of people like playing volatility. It can be great when it's good, but when it's bad, it's really bad. So if you're speculative or short-term momentum trader, this would be the one you'd probably be looking at, but just be careful. That's all I'll say with it. All right, so now that we've covered the 4 plays for this week, let's go ahead and take a look at the charts of these. Because as the old saying goes, a picture is worth 1,000 words, and a chart is just like a big picture of the stock. So we'll go ahead and graph all of them here, pull them up. And the first one, TLT. Now, the reason why I like this one is because, yes, it's been moving lower for most of 2022, but we are starting to finally see a breakout. To demonstrate that, I'll use the freehand line from the top, and I'll zoom out just a little bit here to get the previous all-time high set right here around the end of December. So if we connect this high and connect these highs that we've seen throughout 2022 so far, we can see we did get a breakout just about a week and a half ago. So therefore, this long-term decline that we've been in is finally starting to see a potential change in direction. and that's why it's making the list here today. Now, it is in overbought territory based off the stochastics, but as we always talk about, stocks or ETFs can stay in overbought or oversold territory for quite a while. So while it is in overbought, it's not really the big warning sign telling us to head for the hills quite yet. And then MACD, as we can see, is positive on both the short-term and a longer-term basis, so therefore favors the upside going forward here for TLT. Now the next one, DRIP. DRIP has been in a long, steady decline here. But as we've been talking about, we do have that bullish divergence, and we did have a breakout from that bullish divergence not too long ago. So once again, I'll use the freehand line and connect these highs here. There we go. And I'm not trying to get it perfect, just for demonstrative purposes. If you're on your own charts, you can put your lines exactly how you want them there to make sure they meet all the criteria for a perfect trend line. But this is just more of a visual for everybody out there. So as we can see, price has been steadily moving lower for DRIP, but looking at the MACD, which is a momentum indicator, as we can see, MACD has been steadily moving higher, setting us up for a long-term bullish divergence, and getting that breakout from this downtrend line indicates that confirmation that the trend is starting to change. And then getting into the next, DRV. So DRV, we're going to zoom in a little bit here and look at a 6-month time frame. As we talked about previously in other videos, we have a double bottom right around $48 a share, hit once and twice. But we also have a top here, which I'll use the horizontal line this time to really demonstrate it. But we have a level of resistance right around 53.67. If we can break out above that point, especially with the news coming out, that could be the opportunity from this consolidation that we're looking for to give us that buying opportunity here. Then last but not least, UVXY. UVXY has been in a steady decline. With all the craziness and all the worry in the markets, we're not really seeing the fear gauge reacting as much as everybody would be expecting to. But as rates continue to climb, as that starts to affect more and more companies out there, volatility could be picking up in the very near future. So definitely one to keep an eye on. Also at the same time, as we talked about those bullish divergences, we can see with the freehand line, we've been hitting a lower low here, but at the same time, the MACD has actually been hitting a higher low, therefore not confirming that most recent low and suggesting that upside potential may outweigh downside risk. But once again, you may want to wait for a breakout from the downtrend here. One last thing I'm going to add with UVXY is we are starting to see stochastics coming out of that oversold territory or above that level of 20, which indicates a new uptrend is starting to form. And with the bullish divergence, this could be one to definitely keep an eye on throughout the rest of the week. So thank you all for tuning in. Hope you enjoy these picks. Let me know down in the comments which pick is your personal favorite and what you're expecting once again with the rate hikes. Do you want to see, or do you expect to see 0.5%, or do you expect to see 0.75%? So with that, thank you all for tuning in. I hope you have a great rest of your day. Be safe out there this week. And until next time, toodles.
Yeah.